Well, I want you to know that the Fed finally got a big victory this week. Egg prices are down. This is Randy Kirk. We're going to be talking about the week so far, the midweek report. What's happening with financials? How are those financials affecting Tesla? How is Tesla going to do in the next few days or the next few weeks? If this is content that's helpful to you, please like. That helps me to understand that you like it. Or like it later after you've decided whether I had anything entertaining to say. This is just for your entertainment. This is not financial advice in any way, shape, or form. And so let's dig in and see what is going on in the wild and crazy financial world right now. Well, it is wild, and it's probably a fool's errand for me to even try to analyze or report on what took place today, or to say how it fits into, history, or and what certainly a fool's errand to try to say what's going to happen in the future. But guess what? Fools rush in where angels fear to tread. So we will go ahead and we'll take our best shot at it. Well, let's this is history, but I want to put it in context. A few years ago, we broke the normal markets. Everything that has to do with capital markets working normally was broken by government intervention. We had mandatory shutdowns of factories and industry and retail and wholesale and restaurants and travel. We had wholesale shutdowns, mandatory break in business activity that obviously is going to mess up markets. Then we turn around and we start sending out money. We start sending out piles and piles of money to people that have no way to spend it because the economy is shut down. So you get an extra $700 or $1,000 or $1,500 in your bank account, and you can't spend it. There's no place to spend it. You can't go to a restaurant. You can't take a trip. You can't go down to the retail store and buy something. You can buy on Amazon, but Amazon's running out of stuff because the factories aren't making stuff. So that kind of broke the market. The market is broken. There's way too much money chasing way too few goods and services. We already know this. I'm just reiterating it in order to kind of set the stage. So then we come into the post-COVID. Okay, so there's no more lockdowns. The economy is sort of operating on something closer to normal, but now we have all this pent-up demand, people with money in their pockets, and they haven't been able to spend it. Their savings are at historic highs. Credit card balances are at historic lows. And so people are like, no, we're going to go party. We're going to go buy stuff. We're going to go travel. We're going to go eat at restaurants. We're going to do all the things we couldn't do. And so people go out and they start spending. Well, the problem is that the supply chains are dammed up. Okay, there's not enough supply of some things. And as a result of that, you have these mismatches now in the economy. And that, of course, is going to start causing inflation. To make matters more interesting, one more overlay on this entire thing is that the economy had gone through this weird period of very, very, very slow increases in the economy, which went along with slow increases in the demand on labor and then eventually labor got to the place where there wasn't any available. And this is pre-COVID. We go into COVID, we have this V-shaped situation that takes place, but basically it didn't really change the labor market at all. And we come out of COVID with very, very low unemployment. And as I've repeatedly made this statement, because it's so critical as part of understanding the financial situation we're in, with 1.9 or 2 jobs available for every one person looking for work. And yes, some people backed off and they weren't coming back into the workplace quickly, but now that's over. And we've even seen last week reports of women who might have stayed out of the marketplace longer, starting to come back into the workforce, but that moved the needle a little tiny bit. Overall, we still have massive number of job opportunities for almost nobody looking for a job right now, except maybe to improve their lot. By the way, even on that, we saw fewer quits Quits are evidence of people thinking, hey, I can do better if I quit my job and go someplace else. We did see a slight decline in quits, but I would expect that also after a couple of years, people should be landing at jobs they like and staying because they're enjoying themselves and they think that they're being paid fairly. So I'm not so shocked to see a few less quits. Those few less quits also might be partially due to the fact that we're starting to see some layoffs in tech and layoffs in some of the managerial positions. So that might be putting a little fear into people about quitting their job. So those are some of the things that are going on. Okay, now let's go back to history. We have a Fed who took a look at this inflationary situation and a Treasury Department, our own government, the Fed and the Treasury, both saying that the inflation was transitory and therefore there was no need for the Fed to do anything about it. By the way, I agree that that by and large, the inflation was transitory, caused by unique circumstances that had nothing to do with the capital markets, nothing to do with manufacturers and distributors and retailers, et cetera, doing incorrect things, over buying or overselling or overmaking or anything else. It had to do with COVID and what took place afterwards. So I agree that I agree with them. They were right. It was transitory. However, sometimes you need to have some moderation. If the Fed's going to get involved at all, if the Treasury is going to get involved at all, you do have to have some moderating behavior when you've got this crazy problem of not enough goods to satisfy the demand. And services, people wanting and desiring services at record levels, forcing up labor, forcing up cost of some raw materials, et cetera. That was all taking place, and the Fed made no move at all. I think we can all say that the Fed should have moved sooner and slower. When they finally did act, they were panicky. You don't want your Fed and your Treasury to be panicked. They need to be stable, stalwart. They panic. They're like, oh my gosh, we didn't act fast enough. Now we're going to have to act, and we have to act crazy. We're going to have to, and that's not me saying it. That's Kathy Wood saying, fastest increase in rates in history to deal with an inflation rate that wasn't that crazy and which you could explain away based on circumstances, which they had themselves, the Treasury and Fed, had recently explained it away, saying it was transitory. And now all of a sudden they're panicked over what they believed to be transitory only weeks before. So what do? They raise the rates. They raise the rates, and they keep raising the rates at extremely fast rate. Well, you know, you're supposed to, the Fed and the Treasury are also supposed to be looking for the consequences of these raises better than I can, better than you can, better than the man on the street can. They should be able to say, what could possibly go wrong? Well, what could possibly go wrong is all of a sudden you have a bunch of regional banks that are in trouble because of their smart decisions. Now, I'm not going to give congratulations, or I'm not going to be a supporter of SVB. I think SVB made lots of other mistakes. However, having said that, the mistake they made was they invested in bonds at 1.7% interest when that was a smart move. And then they didn't create any kind of a decision-making process to get out of that as they saw the rates going up and up and up, which meant that the value of their underlying asset was going down, down, down. And of course, if you're in the banking business, you need to have your assets be strong. And if they start to become weak, more and more weak, at some point, you're in trouble in terms of your balance sheet. And banks, more than anybody, have to pay attention to the balance sheet in order to have a strength that depositors can rely on. Well, it wasn't just SVB, it was other banks. I have a friend who's a banker. I won't mention the bank. She says that there's just panic at their bank as really good folks are moving their deposits out of this bank, and they're on the phone trying to convince people, look, we're not affected by this. We're fine. Our balance sheets are great. So no, this is now a systemic problem where all bankers are having to look at this and figure out what in the world are they supposed to do. Well, so then Credit Suisse, a significant bank, says, oh my gosh, we've got a problem too. They're not even an American bank, although they have massive amounts of American deposits and American interactions going on with their bank. But they're like, no, we've also got issues. And they thought that their Saudi friends would bail them out, which they didn't, and said today that they wouldn't. So the market went kaplooey. It went down like crazy. Everybody was affected. Everything was affected by it. Everything went down. And then their government came along and said, no, we'll back them up. And then the market responded, clawing back a pretty good percentage of the losses from today. However, at this point, we're now looking at the S&P being down for the year. I'm not sure that was true at the close, but it was true very, very close to the close. And so you got the S&P being down for the year. You've got a market that is in complete disarray. What does that really mean? Well, first of all, I'm hoping what it means is the Fed is going to pause. They've got to pause. In addition to everything else that happened today, you had the 10-year bond, and if you follow my 3 times a week, I talk to you about the financial situation. On Friday night, I give a week in review. On Sunday night, I give you my Monday morning analysis. And then on Wednesday, I give you the midweek. You know that I've been laser focused on the 10-year bond. Why have I been focused on the 10-year bond? Because that's an indication of what the gang, of what the street, of what the crowd thinks inflation really is. And what we've seen is that the 10-year bond has been dropping from a high of around 4, which still would have only suggested inflation at 6%. That bond, I did that backwards. Bonds at 4% would suggest inflation at 2% long term. And now it's dropped back down under 3.5 in just a few days, dropping radically. But more interestingly, well, maybe not, but just as interesting, how about that? The 2-year has dropped even faster. So the 2-year, which has been inverted now for months and months and months, but inverted at sometimes by 100 basis points, which is crazy, is no longer inverted by 100 basis points and is coming closer to parity with 10-year, which of course it should be the other way. It should be at lower interest rates than the 10-year. So that's huge. And it should be a signal to the Fed. That should be a huge signal to the Fed that they can pause or should pause. The banking situation should be evidence that they should pause. The 10-year bond and the 2-year bond now should be an indication that it's time for a pause. And then didn't even get a headline. You may not even know what happened. I may be the first reporting to you. The PPI, producers price index, the PPI was down today, missed on the low side by a lot compared to what the street was expecting. That is normally bad news. That was indicate we're going into recession, into deflation. But in this environment, it should be good news. The Fed should be looking at that. And the Fed does rely a lot on the PPI in how they make their decisions. The PPI was down dramatically compared to expectations. And it was across the board. It was everywhere. And so it's a really, really good piece of news. In addition, the Fed should, I think they do, pay a lot of attention to oil. Again, as I mentioned commonly here, oil is something that affects the entire chain of distribution. Everything is affected by oil prices, from travel, transportation, food costs, product costs, everything is affected by oil. So when you see the oil prices dropping, they dropped at one point, they were down 6% today. And that is not like off a high, that is off of 2 days in a row of dropping to where we're now under $70 a barrel. So that's a really, again, good piece of news. In general, that's a good piece of news for the economy because oil prices, gasoline taxes, those are actually kind of a tax on, because it's kind of a utility area. It's kind of a tax on the population. When those go crazy, there's nothing you can do about it. You have to buy gas. You have to buy natural gas for your home. You have to buy electricity that's commonly powered by natural gas. So this is good news for the overall economy to have those in deflation. But the radical way that they're dropping is a little bit shocking, and again, should be a signal to the Fed. So we're certainly hoping that the Fed is paying attention to all of this. What about Tesla? Well, Tesla was down, but basically pretty much Tesla is following the market right now. There's no real news. The world of the folks in the Tesla world, and even those on the edges of the Tesla world, seem to be really starting to get what happened in Investor Day. There's no question that Tesla has a roadmap right now that is unbelievably clear and unbelievably doable. And it's just a matter of execution. And the potential for Tesla is to be at least a $1.5 trillion company by the end of this decade, and probably more on the order of $3 trillion in sales, making it far and away the largest company in history. Aramco has just proven that it is certainly possible to make $200+ billion in 1 year in profit. I think that Tesla by the end of the decade will be making probably on the order of $350 billion a year just in profit, and potentially $1 trillion in profit, depending on things like FSD. Okay, so Tesla, I'm expecting Tesla to continue to follow the market for the next multiple days. However, something to watch for. I know it's 2 weeks away, a little over 2 weeks away, but when we get the print for the first quarter unit production, the production in the first quarter, which is going to indicate something to do with the amount of units sold, I think it's going to be lower than the street expects. It might actually equal the street's expectations. It's not likely to be higher. And that's because for some reason right now, the street is pretty optimistic in their average analysis of what Tesla will produce in the first quarter. Troy Tesla and others are under the street, which is very unusual. So I believe that Tesla is sandbagging, but you can't sandbag that number. So I'm expecting second quarter, third quarter, fourth quarter to be much bigger than what the street is. But at least at this first quarter, if you want to think about where Tesla stock is going to go in the short term, it could be that we're looking at 2 or 3 weeks where the Tesla is going to just basically follow the path of the market. But first quarterly earnings could be where we first begin to see revenue and profits from these other divisions in significant enough quantities to move the market. And maybe some of the report in the earnings call, some of the questions in the earnings call with regard to Cybertruck, semi-truck, and Lathrop and other divisions, some of those questions might be revealing enough to actually get some of the street to understand that there's more to Tesla than just sexy. Okay. In the market generally, I would expect tremendous wariness for the rest of the week. I think that there's going to be, it could be flat. Anything that happens with a small regional bank or a national bank, any negatives are obviously going to just floor the market. It's not going to be good. I don't see where any upsides are going to come unless there's some kind of Fed statement or Treasury statement. That could obviously create an upside. So I see tremendous wariness in the market for the rest of this week. The Fed is going to come out with their decision on the 21st or the 22nd with regard to interest rates increasing by 25 basis points, increasing by 50, or staying neutral. I would also look for what kind of statements are going to be made. What will the Fed be saying? Are they going to give any kind of a dovish analysis that would say, we are aware of what's happened with these banks, and we acknowledge that we just have to be careful for the next several weeks or months? So there you go. That's my theory. I'm sticking to it, but I'd love to hear your comments. I'd love to hear your theories. Please comment below. Please let me know what you're thinking. And as usual, it's been great talking to you.